Welcome to Financial Counseling Unit 7, Insurance. Let's talk about insurance as a whole. It is a key cornerstone to a strong financial foundation. Now, we previously discussed the need to establish emergency reserves in our financial plan, right? In this unit, we'll discuss the importance of being properly insured in order to develop a strong financial plan. Many consider insurance a waste of time and money. Without insurance or financial plan, our financial plan is weak, which is not good, and it could collapse, right? Without proper coverage, one emergency or disaster could bring everything, all of our hard work, tumbling down. So insurance is very, very important. It's a big part, let me tell you. So the different types of insurance that we're going to talk about today are health insurance, life insurance, disability, homeowners, and auto. And with health insurance, the way that basically works, which all of us know, but sometimes we need to refresh our clients, it's a shared cost of expense for the patient. You pay a premium, and then you pay part of the pay for the service. Of course, depending on the kind of insurance you have. Some insurances, some programs, you have no copay. Traditionally, though, there's a copay. So we got our little guy there in green looking on the left. That's us. We pay our insurance company. The insurance company then reimburses the doctor. Part of the fee, we pay a supplemental copay. And in turn, we receive treatment and preventive care. Now, health care insurance, it's basically, like I said, patient's share of the cost. It may include a deductible, which is the individual's agreed upon portion before insurance begins to pay coverage. It may include a copay, which is a fixed amount owed for care, namely visits or prescriptions. And it can also include what's called co-insurance. Now, co-insurance is going to be a percentage of total cost. For example, the plan could cover 80% and your client could pay 20%. So it just depends on what type of policy they have. Insurance, healthcare insurance, historically, plans provide full coverage or a fee-for-service schedules are mainly used. Hold on, let me go back a second. There we go. There's a second part to that. Currently, managed health care plans are more common, and managed health care is defined as a variety of techniques intended to reduce the cost of providing health care benefits and improve the quality of care. So it's sort of like cookie cutter, so to speak. Managed care, and I love the graphic here with the little girl playing doctor, but it's a way of providing services at a more affordable cost is the idea. All right, so we've got 3 basic types of healthcare plans. You've got health maintenance organizations, or HMOs, preferred provider organizations, or PPOs, and then primary care physicians, PCPs. With the HMOs, the care provider must be within that network. The HMO's network is generally the most affordable. They focus on preventive maternity and well baby care. They're attractive for young and healthy or new families, and care is highly regulated. Dissatisfaction usually arises with illness. So they're better for, like I said, preventive, simple stuff. The PPO contracts with a network of preferred providers. No requirement to select a PCP or use a preferred provider. Referrals are not required on this particular program. Only responsible for your annual deductible and copays for in-network. Using out-of-network is costlier, and you must file a claim and just get reimbursed. So it's a little more of a headache, but at least you have options to go outside. The primary care physician, many plans require insured to designate that person. The PCP coordinates all care. Referrals to specialists must be approved. It's important to have a strong relationship with that person and communicate, and they should communicate well with their patients. And then we've got government programs, Medicaid and Medicare. Medicaid is a program for families with low income or limited resources. Primary oversight is handled by the federal government with some mandatory requirements, so check page 4 for that. States are able to set their own eligibility standards and administer program parameters, so check 5 to see where you are. And it must cover groups considered categorically needy. So counselors, you should research your eligibility requirements for your state and make sure you're just aware of what they are. Medicare pays for hospital and medical care for elderly and certain disabled Americans. Two main parts for hospital and medical insurance is Part A, which is the hospital insurance, and Part B, which is the supplementary medical insurance. There's 2 additional parts for coverage for flexibility and prescription drugs. So C allows to customize a bit, and then D is the prescription drug plan. The non-governmental access to care is like pro bono. That's where a doctor donates their time, usually to a local community clinic. And in exchange, they can get a tax break for that. Open door clinics, which provide health care at greatly reduced costs or free. Oftentimes, you see them on a sliding scale, so it'll be based on your income. And then federally qualified health centers provide services to underserved urban and rural communities, and they get their money from the federal government. All right, so patient-provider relationships. These are very, very, very important. Clients should always have a primary caregiver they trust and someone they meet with at least once a year. Most low-income families, clients don't go to a doctor unless they're sick. So we highly recommend that we try to encourage our clients to go in annually for their preventive, even if it's just a basic health checkup, a physical. Most plans these days cover that with as part of their preventive maintenance, and so you just have that small little copay. So I highly, highly recommend that because it can oftentimes catch things before they get out of hand. This personal relationship, again, is important because that doctor will know their history. It'll be someone they feel comfortable discussing concerns with. Once they develop that relationship, I don't think they'll be so tentative. And this doctor is the person who's going to coordinate and manage their health care. So that's really important. I know my grandmother hated going to a doctor, but I swear if she had found one that she really liked and trusted, because she was very fiercely loyal, so had she found one that she really liked and trusted, that probably wouldn't have been as difficult a challenge for us to get her to go to the doctor. All right, moving on. There are 5 key outcomes of the U.S. healthcare reform. The first one that we're going to talk about is the healthcare insurance exchanges. That's for those who without employer coverage. So they've got so if you're self-employed or if your job does not offer healthcare, you can go through the insurance exchange. Funding for the Children's Health Insurance Program for CHIP that happened in 2013. Expanded authority to bundle Medicare payments to streamline the process that also happened in 2013. Increasing Medicare and medical payments to PCPs, again 2013, and improving preventive health coverage by increasing Medicaid funding to states. So that's all part of the Affordable Health Care Act, and there's more information on that in section 7.1. I highly recommend you read that section, get very familiar with some of those key changes. Some other pardon me, outcomes of the healthcare reform, information online, it's required for everyone, coverage for early retirees, coverage for children, there's a crackdown on fraud, prescription drug discounts, increased access, that was really huge, more efficient care, there's an advisory board now to oversee that, better payments to physicians, small business tax credits, so there were a lot of benefits that came out of this. Despite what you might hear on the political side, just as a real-time program for a lot of our low-income people, it was very beneficial. All right, let's move on. So tips for making the most out of health and healthcare. Study available healthcare plans. So if your client is employed, they can go with the employer-covered plan, but they should also check and see what's available on the exchange because they may find a plan that's less expensive. So they should do their work. Usually, if it's a single person, the employer covered plan is going to be the best one because it'll be very inexpensive, but if it's a family, then they really should check around. Study health, know their health status and rights. They need to be aware of that. Find a cooperative primary care provider willing to work with others. So if you're in a local community and you know that there are some doctors who are really wonderful and some who are not so much, have a list. So people who may recently relocate to your area and seek your services, you can have a referral for them. Let them know they can contact their insurer with any questions. Do your part to stay in shape and take care of yourself, of course. And we're actually starting to see the country move in that direction. It's a beautiful thing. We're starting to see more information about GMO food, about eating healthy food and less processed food. I'm a big social media person, and so when I start to see more articles and more articles about folks demanding healthier food, it makes my heart sing. Communicate with the provider, ask questions. Let them know just because the doctor says this does not mean that's what they absolutely have to do. They're totally okay to ask questions, to seek advice, seek a second opinion, and they should keep a file of their own personal health care. So most of it's online, but it's always good to keep your own copies. All right, so the next one of the insurances we're going to talk about is life insurance. Why would your clients need life insurance? Take a minute and just think about that. You can pause this and then come back. Life insurance is going to be good for if they're getting married, if they're going to start a family, if they're going to purchase a home, a new job, or even retirement. All of these are good for are good times for them to get life insurance. Because think about it, if they get married and something happens, usually when you get married, you were two independent households before, but then you merge everything into one, and maybe one income isn't enough to sustain it. So if something happens to the other one, you don't want that, the surviving spouse doesn't want, it's going to be challenging for them, possibly, to have to maintain that household without the other spouse. So life insurance can help there. Parenthood, obviously, if something happens to one or both of the parents, you want to have some money set aside for the children. Home ownership, in case, let's see, again, something happens to one of the homeowners, you want to be able to pay off your mortgage and still live in the home. Life insurance can actually cover that, because homeowners insurance covers the home in case it burns down or anything like that. But if something happens to one of the partners in the home, homeowners insurance doesn't cover that. New employment. You may start a new job, but maybe it's not working out so good. So you just always want to be safe. And usually a new job, sometimes with that comes new life insurance opportunities. Nice to have a separate policy just in case. So that way, it's okay to have it tied to your job, but you also want to make sure you have enough so that if you lose your job, you still got insurance. And then, of course, retirement. You may need that to cover any expenses still in case something happens to you while you're in retirement. So life insurance is a good idea. Let's talk about the types of life insurance. We've got individual, which is underwritten separately for each person. A group life insurance, something you see with your job, like we just talked about on the previous screen. Your employer may have it, unions may have it, associations may have it, so you can be a part of that and get a reduced rate. And then credit insurance, which guarantees a payment of credit, including mortgages. So if you purchase a home, you will oftentimes get a notice for mortgage life insurance. Now that will cover in case something happens to one of the spouses. But that reduces as you pay off your loan. So your mortgage life insurance is only covering the balance, not the original amount, which may be okay with you. But just want to make sure you're aware of that. As far as individual life insurance, there's two types. There's term and permanent. Typically, I think we think of term and whole, period. But whole falls under the permanent umbrella. Now, term insurance is going to be the most affordable. It's going to cover for a specific period, hence the word term. Coverage will terminate right at the end of that term. Renewal will be likely, but more expensive. Let me say that one more time. Renewal will likely be more expensive. There we go. So, and I've actually just experienced this myself. I had a term policy that when the term ended, the policy didn't necessarily end, but the payment tripled. So that was quite a jump. And I was able to find another term policy at a lesser amount. So just be aware of that. There's no cash value with term. The risk being uninsurable after the term ends. So that's possible. If you do term life and you end up developing an illness that could make you uninsurable, then you could lose the policy once it expires or the term ends. Now, with regards to permanent, like I said, we have whole life, we have universal, variable universal, and variable whole. So with the first two, whole life, you've got the premium is constant. It's higher than term, less expensive in the long run though, and there's a cash value, which is kind of nice. With universal, the premiums are flexible. There's a death benefit, and we'll talk about that in a little bit. There is also a cash value. There are some added administrative fees for that. Now with the variable versions, on the whole life, the premium is still constant. It provides an investment option for cash value. So you can keep the cash or you can invest it on the variable one. There is a death benefit and the cash value. They both fluctuate depending on the performance. Because see, you can invest it, so it's going to be based on that. On the variable universal, it's similar to universal regular. It's adjustable, provides investment options, just like the whole variable, greater risk on that one. And the policy collapse if it's not managed well. So a little more risk on the variable versions than the regular versions, so something to keep in mind. All right, policy basics. And you want to turn to page 200 in your book to kind of go over some of these policy basics, but I'm going to share some information with you now. On the insurance agreement or the contract, that's the section of the policy that specifies what the insured is covered against. So who is it covered, the length of the term, etc. So you want to know where to go for that information. Ownership rights. And insurance is the provision or the endorsement that designates the owner of the policy. When such owner is someone other than the insured, for example, a beneficiary, this clause vests ownership rights to the specified person or entity. So for instance, I can buy a policy for my husband. So I own the policy even though he's the insured. Does that make sense? Or he could buy a policy for himself and then he has ownership rights of his own policy. Either way, you're going to have I'm going to skip one, the beneficiary clause. So you're designating who receives the money in case you pass away. And then, of course, death benefit is the amount that's paid out in case either of us pass away. So all these terms are things you want to be familiar with when we're talking about insurance. All right, how much is enough? Tips for buying. Consider financial situation and goals. So you don't want to recommend, and actually you really want to refer them to an insurance agent who can really go over the details with them, but they need to look at, how much do they have left over at the end of the day? And that's something you will be working with them with because you're working on their financial plan, their spending plan. So if they only have $50 really that they can allocate, then maybe they should look at a term policy that will fit within $50 a month. And they may have it, especially if they're renting, they don't have children. Now, if the situation is different, they have longer term goals, then they may want to look at something else. So it's really going to be on a case-by-case basis. You want to weigh short-term and long-term needs. Contemplate options. Have them shop around. There are a lot of insurance companies out there. So have them make sure they get in the one that really suits them. They should make sure they understand the policy. Part of that is knowing those terms we just went over. And the free look period. And what a free look period on insurance is the period where, and I'll give you the actual definition, a new insurance policy owner is able to terminate the contract without penalties, such as a surrender charge. The period often lasts 10 or more days, depending on the insurer, allowing the contract holder to decide whether or not to keep it. If he or she is not satisfied, the contract purchaser can receive a full refund. So that's really nice. They've got a period of time where they can kind of, okay, I got it, but I'm still shopping. maybe they found an incredible deal and it's almost too good to be true, but they don't want to pass it up so they can get it. Make sure they know what the free look period is and then continue shopping and comparing. They should be comfortable with the company, the agent, and the product. Review the application with them for accuracy, and then make payment to the insurance company, not the agent. So that's important. All right, insurability. The first one, getting insured is not guaranteed. Well, that used to be the case. Now they can't deny you because of previous medical history, right? Now what can happen is your insurance may be, depending, it may be costly. So I guess I didn't want to remove that line altogether and say getting insured is not guaranteed, because if you don't have the money to pay for it, even with the subsidies and the credits, etc., then you don't have insurance. So that's still possible, but at least the previous medical history is not held against you, or is not the one reason that they can deny you. Does that make sense? All right, medical history is reviewed. A physical exam and blood test is required. Typically, there are some insurance plans that don't. It depends on the amount, usually, and age and health and all. So they'll take all these things into consideration. And sometimes they require, a physical, sometimes they don't. Other factors include occupation, family medical history, driving record, and more. Believe it or not, if you drive like a maniac, that can affect your insurance. All right, so once approved, insurer cannot drop coverage except for premium, non-payment, or expiration of policy. And you know what? Let me correct myself, as I just caught it after I finished. The getting insured is not guaranteed. That's absolutely true. I'm thinking for health insurance, and we're talking about life insurance. So life insurance is not guaranteed. And I'll go through and correct that later, but I just wanted to make sure. When I went through and I was previewing the slides, I was like, oh no, that's not true. Affordable Care Act, but that's on health insurance, and we're talking about life right now. So I want to make sure I give you the accurate information. But I do know that not all life insurance policies require a physical exam and blood test. So in that case, if you know that your client has previous medical issues, then you may want to look for a policy that doesn't require that. And that will entail probably getting the help of an insurance professional who's got experience and can recommend you to, particular companies that they work with where they know for sure they don't require it. All right, so let's move on. Let's see here. All right, disability insurance. Why would your clients need disability insurance? Well, disability insurance is good in case they lose their job, or if there's an accident as a result of work. It covers the loss of income. And ideally, you want to have that in place before the incident happens. Now, if it's at work, usually workman's comp will kick in, or if it's, major disability, then disability insurance or supplemental security income will kick in. But if it's a disability and it's not job related, then an individual policy is always good, because if they have to be out of work because they got hurt playing, some sort of sports on the weekend and they can't work because of it, their job's not going to pay them. I mean, they may have used their vacation. They can use vacation or whatever, but once that time is passed, especially depending on the severity of the illness or the accident, they may need their own insurance to help cover. And you hear like companies such as Aflac, I'm not recommending them as I've never used them myself personally, but companies like that are companies where your clients can purchase disability insurance directly. So here's some disability insurance terms. Of course, the benefit is the amount that the person will get during the disability. The benefit percentage can vary depending on the term. So you may get a certain percent right away, and then after a period of time may reduce to a different percentage. And then there can oftentimes be a waiting period, so you want to know what that is. There's a specific benefit period. It's not going to last forever, so you want to know what that is. And then, of course, any exclusions you need to be aware of, riders or like conditions that you need to be aware of, and then underwriting, what's going to take to get this approved. So again, best to talk to an insurance professional regarding disability insurance. But make sure that your client asks about these terms because they want to know this information before they sign on the dotted line. So when counseling a client, does the client currently have coverage? You want to know that. Are they sufficiently insured? So again, if they have, if they're married and have children and own a home, do they have enough insurance so that if one of them, the primary care or the primary breadwinner, for instance, if something should happen to that person, is there enough insurance to cover the family? Do they have sufficient reserves to sustain themselves during the waiting period? Can they afford to purchase additional coverage if needed? Those are things you want to ask. All right, so government disability programs. Social Security Disability Insurance, we see this a lot, SSDI, pays benefits to people who cannot work because they have a medical condition that is expected to last at least a year or result in death. So if it's a permanent medical condition. I recently had a chat with an outreach coordinator for an HIV/AIDS clinic, and it actually made me happy to hear that HIV is no longer no longer mandates Social Security disability because of the progress they've made with health care and treatment of the disease. So that's really good because it used to be a death sentence, right? You knew that they wouldn't be able to work and they would die fairly quickly, and so I'm very happy to hear that that has changed. Other things you want to know is there's a recent work test, and that's based on the age at the time of the disability. A duration of work test to show sufficient work history to earn disability. Certain blind workers have to meet certain blind workers only have to meet the duration of work. They don't have to meet the age test, so that's nice. Supplemental security income is designed to help aged, elderly, blind, and or disabled people who have little or no income. It provides cash to meet their basic needs, food, clothing, shelter, etc. Now we have homeowners insurance. This one I'm quite familiar with. So we've got homeowners insurance covers personal property. It covers the dwelling, of course. It covers, let's see, liability, if someone gets hurt on your property, and then detached structures. So it covers a loss of use, provides coverage for living expenses when the property is uninhabitable due to an insured loss. There are exclusions, and that explains what's not covered. For example, damages from flood. I'm sure people in the Louisiana area are quite familiar with that exclusion. But that's something we've all got to be aware of. After Katrina happened, I remember talking to my insurance agent and going over the exclusions and finding out, oh my goodness, there were more things excluded than I had realized. Some other typical exclusions are like home daycares, because that should be covered by a business policy, not a homeowner's policy. Home businesses, dangerous animals and pets. I'm sure a lot of folks don't think about that. War, flood, not covered by homeowners insurance. So you just want to make sure you know what's not covered and either get sufficient coverage or at least just know that you don't have that coverage. And then there are endorsements, which are modifications or extensions to the basic policy. So you may have an endorsement such as replacement value versus cash value, which is what you want, because if you buy your house today and let's say it costs you $200,000, in 20 years to rebuild your home in case of fire may cost $250,000. So you want to make sure you have replacement value and not just cash value. An endorsement may be backup sewers and drains, it may be earthquake, etc. So you want to make sure you know what your exclusions are as well as your endorsements. And now we've got renter's insurance, and that basically covers individuals who are living in a home that's owned by someone else. It's really inexpensive, and it covers for loss of use of personal property, loss of use of the apartment that they're renting, as well as theft. Some cost-saving tips for your clients. Shop around and compare. That's the biggest, and that's really for all types of insurance, right? Consider increasing deductibles. So the the change from a $500 deductible to a $1,000 deductible can be quite huge, especially if it's a place you know you're going to be in for a long time. So you can just put aside that $1,000 to cover that deductible, and then you're not paying, so much extra money, because it can add up. Within 2 years, you can easily pay that extra $1,000 in your fee for having a lower deductible. And then, so check the break-even point. If they plan on being there past the break-even point, then definitely go for the higher deductible, because it's going to save them money. Ask about discounts. Oftentimes you can get multi-policy discounts. Loyalty may pay, so if paying free for several years, that could be a credit for you. And of course, keeping good credit standing. You can actually not be eligible for insurance if your credit's bad. Disaster prep. So check coverage annually to ensure that you're properly covered. I live in California now, so I have earthquake coverage. You want to take inventory of belongings regularly, so make sure you have a list. Store a copy of that inventory off premises. I keep mine on an online server, so that way I have access to it everywhere. All right, automobile insurance. What is considered in determining those costs? Age, gender, the type of vehicle you drive, your driving record, as well as your location. Coverages are defined like this: bodily injury liability, which covers injury or death, claims against the insured, including all legal fees. There's property damage liability, which covers damage to the auto or others' property in an at-fault crash. Medical payments, which covers for medical and funeral expenses for insured and passengers regardless of who's at fault. We've got uninsured motorists, which covers injuries of insured and passengers when in an accident caused by an uninsured motorist. I remember when I drove through New Mexico, I think it was, and we ended up renting a car for the day because our car needed some repairs on our trip out, and we were told that New Mexico was the state with the highest number of uninsured motorists. And so it made me a little scared, although I didn't want to pay for the supplemental insurance, and I didn't, but it just made me nervous, like the day we were driving this rental car, because I was like, oh God, if someone hits us, we're in trouble here. There's also underinsured motorists, so that covers at-fault drivers' policies when they do not cover the total loss. And then there's underinsured motorist property damage, which covers insured's vehicle when the accident is caused by an uninsured motorist. So you've got injuries being covered by uninsured motorists, and then property damage covered by uninsured motorist property damage. All right, so we've also got collision, which covers damages to vehicle regardless of who's at fault. Other than collision, comprehensive, which covers damages to vehicles other than those caused by collision. So if it's theft, vandalism, fire, windstorm, flooding, etc. Let's see. So parts of an auto policy, it'll break down like this. You'll have your declaration section, which personalizes the policy. You'll have your coverage section, which details the coverages that are included. You'll have the supplementary payment section, which provides coverage for liability expenses incurred beyond policy limits, if you have that. And then you'll have exclusions, and that will state what's not covered. You also have conditions, which must be present or met by the policyholder and insurer. You'll also have the definitions and general provisions section, which contains miscellaneous information. It'll have the definition of the policy terms. It'll have conditions regarding the policyholder and insurer's rights. And of course, it's all in fine print, so a lot of people just gloss over it, but it's good to read it at least once. And then, of course, there'll be the deductible, so you'll know how much you have to pay before the insurance will kick in. Some cost-saving tips for auto insurance: comparison shop. So like with all the other types of insurance, you want to shop around. You want to look at increasing your deductible. Choose the right car. If you have a two-seater red Ferrari, your insurance is going to be much higher than someone with a Toyota sedan, for instance. For older cars, consider eliminating collision and comprehensive coverage, because it may not be worth it if the car is only worth $500 or $1,000. It may be worth just, if the car gets trashed, okay, it's time to get a new car. Or that's when you work with your client on putting, a short-term plan is to have enough money to buy another car just in case. Ask about discounts. Of course, be safe, defensive driver, and keep tabs on your credit. And a big one is be safe and a defensive driver, because you can get points in your license even if you weren't at fault. So you want to make sure insurance companies will look at it. If you're in enough car accidents, even if they weren't caused by you, that can cause your premium to go up. So definitely be defensive, be conservative. I always try to keep a couple car lengths in front and in back of me. My husband gives me a hard time, but I haven't had a ticket or an accident in 15 years. So, it's worth it, right? All right, so that's it for insurance, and thank you. This is the end of Unit 7.